Okay, fact number 6. She withdrew $1,100 in cash for personal use. All right, withdrew, withdrawals, drawing, owner's drawing account. We've got a drawing account over here. This is going to be minus 1,100, and it's going to be minus 1,100 over here in cash. Now let's explain what this is. Withdrawals are when the owner takes money out of the business and then goes and does whatever they want to do with it. So let's say Sharon is really busy and working really hard at her law firm. She wants to take a 2-week break and just go to the other side of the world. And it's going to cost $1,100 to get her there. So what she's going to do is, it has nothing to do with her business, so it's not an expense. She's going to withdraw money from the business because it's her business. She can do this. And she's going to then use it for personal reasons. Okay? She's drawing down the cash of the business, but she's allowed to do it because she's the owner. Now, you can imagine how this type of the ability of someone to do this is where it gets more complicated when you go into partnerships and LLCs and corporations and other forms of business. We have to think about partnership rights and what partners or owner rights and what they can do. But for a sole proprietor, she has the full right to do this, and we hope that she has a good vacation. Okay. So fact number 7, she received $1,700 from Standard Federal Bank, money borrowed on a note payable. Okay, so the textbook here threw you a little curveball. They gave you these upfront accounts, and then they threw a new account in the 8 facts. We need a note payable here. Okay, and we're going to create it right here. This is similar to the account payable, similar in concept. It's going to be an obligation to pay. And we're given the amount that it is $1,700. Okay, so $1,700 goes up under the note payable. Whoop, I have that on the wrong line. My apologies. Okay, and then $1,700 goes up under cash. Again, let's think through why she might do this. It's always critical to think through the why. She needs $1,700 to get new furniture for her office. She doesn't want to use her own cash. A note payable is similar to an account payable in that it is a promise to pay. It's similar, and it's also a little bit different. An account payable is like a revolving sort of arrangement that you might have with a business, with another business, similar to the law firm and the paper supply company. A note payable, a good example is with a bank, and it's where basically you can go and get typically kind of a lump sum of cash, as is the case in this example. And then the cash is actually stated on what's called a note, which is basically kind of like a loan document. And usually there's typically an interest rate that's listed there as well. All right, fact number 8, the final fact. Incurred utility expense for the month on account for $330. Okay, we have another expense over here. Let's put it in here. It's an expense, so it draws our equity down. And this time, we're given that word on account. So the idea here is that she has now an account payable, okay, that goes up. Now this is probably the least intuitive piece of this problem. And it leads into the need for sum totaling all of the accounts going down from top to bottom. At the end of every single month, we must close our books and create our financial statements, okay? We create the 4 financial statements, which we're going to look at separately, okay? This exercise kind of feeds into it as part of your problem. Now, the financial statements, once you have all the data, it's a matter of just like presenting it. And the presentation in this chapter is fairly straightforward, okay? If you have the final numbers, you should be able to kind of present the data in a way that's, maybe like 7 or 8 lines at the most. This is all the hard work, quite frankly. This is where the real work is. Because we want to close our books each month, we want to understand one of the rules in accounting is we must recognize revenue and expense as it occurred. So she gets to the end of the month and she has used her utilities from August 1st to August 31st. And the utility company is going to bill her for that time period, right? When you get a utility bill, and look at your utility bill, it's on a monthly basis, okay? Typically it should be on a monthly basis. What she wants to do is record that expense. She wants to show what's the true cost of running this company. What's the true cost of keeping the lights on, keeping the heat on, and so on. So she's going to record the expense, but she's not paying it right away. She's going to pay it later. Okay, she does all her bills at once, maybe, and she'll cut a check later. But she needs to record the expense as of the 31st, and the account payable is like, I'll pay you later. It's basically noting that the company, her law firm, owes the utility company this money. So at a later point in time, we should expect to see this 330 reflected in cash going down. But that won't happen until September. Okay? The final video, we're going to look at sum totaling all of these and then taking it into the financial statements.